So good evening. Continue. Okay. So good evening, everyone. My name is Yvette Jefferson. I am the chair of the Economic Empowerment Committee of the National Coalition of 100 Black Women, Northern Virginia chapter. I want to thank you all for being on this call tonight and for your support of NCBW and the Economic Empowerment Committee. This is our last event for the 2020-2021 program year. And I ask that you please stay tuned for upcoming events for the 2021-2022 program year. Some of the events that you should be on the lookout for is, and I guess this is not part of the 2021-2022 program year, but National Black Women Equal Pay Day is Tuesday, August 3rd. The National Black Women Equal Pay Day represents the approximate day a Black woman must work into the new year to make what a white non-Hispanic male makes in the previous year. You can visit our social media sites to learn more about what's going on to raise awareness about the wage gap inequity experienced by Black women. And that's going to be this Tuesday. And I know there's a Twitter storm that's going to happen. So if you go to some of our social media pages, you will see some of the events that's going on. Also, I want to inform you that we will have our annual forum, Unmasking the Pillars of Resiliency, Health, Education, Economic Empowerment, and Advocacy. That will be this Saturday, November 20th, 2021. And that is going to be a virtual event, and tickets are $25. Before I move on, I want to take this opportunity to thank all of the members of the Economic Empowerment Committee, especially Stacey Watson, who has been my right-hand woman. She was my graphic designer for our flyers. And I also want to thank our first VP, Angela Smith-Mackey, for all your support. So thank you. At this time, if there's any other committee chair who want to make any program announcements, please take yourself off mute and do so. If anyone else wants to make a program announcement. Okay, so if there isn't anyone, I will introduce the presenters for this tonight. And I also want to remind you that this presentation will be recorded and we will have it on our website and social media. Facet Wealth is an innovative financial planning company that is designed to help all people across the financial spectrum. Because every decision you make has financial impacts, your financial planning should take into account everything your money touches, not just retirement or investments. Financial planning is essential to living well. Financial planning should be about your needs, regardless of how much money you have to invest. Whatever your circumstances, you should have access to reliable, personalized financial planning that advocates for you. That is why financial planning should only be offered by licensed, trained, certified financial planning professionals who meets with you personally and acts on your best interests. Tonight, we have members from Facet Wealth, Shatila Winters, Bethlyn Brooks, Danielle Outside, and Tarif Carson, who will present to us this evening the benefits of having a financial planner as they talk about credit and debit, home ownership versus renting. Without any further ado, I present to you Facet Wealth.
Thank you so much for that introduction, Yvette, and thank you to all of you who've taken some time out of your evening to join us. Most people don't spend this much time on their personal finance, so you're already ahead of the game by being here. I'm going to go ahead and share our presentation with you. Can everyone see this presentation? All right, awesome. So as it says on the screen, we're talking about managing money, credit, debt, home buying, and investing. We've already had our introduction. So there are 4 of us here today: Bethlyn, Danielle, who are both lead planners, myself, and we have Tarif, who's also a lead planner here at Facet Wealth. First, I wanted to share how you can connect with us. We are on all the major socials. If you like the content that you hear tonight, you can also check out our webinars. We have a large library of lunch and learn content that talks about other topics outside of these. So we invite you to take a look at that as well. Now, what is on the agenda for today? We're going to be talking about What is financial planning? Our 4 topics that we mentioned. We want to give you some helpful resources outside of Facet Wealth. We'll talk again about how you can connect with us. And of course, we will have Q&A at the end. Now, if throughout the presentation, if you think of a question, you can go ahead and drop it in the chat box. We'll be paying attention, and afterwards we will be answering those questions. So if something pops up in your mind, pop it right in the chat. So first, I want to start out with, why do financial planning? A lot of people think, well, isn't that for just rich people? Well, no, it's for everyone. It's like saying, I have to lose weight before I go to the gym. You do financial planning because you want to grow your assets. And there's things that we want to do. We want to have an emergency fund for a rainy day. You may want to buy or lease a car, start a family, have financial freedom, pay for education, retire someday, and buy homes. So financial planning is important for everyone. So what is financial planning? Well, first off, personal finance is personal to you and your unique situation. And the first thing we want to do is talk about our goals. Now, we don't have to overthink this, but all financial planning starts with a goal. A lot of people start doing things without focusing on why they are doing this. We want to make sure that we write down our goals and prioritize them. What is most important to least important? Give them time horizons and be specific. We're going to talk about that more in a bit. Oh, and the reason why we write down our goals is because you have a much higher odds of achieving them if you write them down. Time horizons are very important because there's different types of goals. We have our short-term goals, like saving for a vacation, midterm goals, if you're going to be purchasing a home or maybe purchasing a car, and then those long-term goals, things like retirement. So we're going to look at the SMART goal framework. And then after we look at the framework, we'll take a look at an example. So first, write down your goal, and it should be specific. What is the goal? How much is it? And when will you achieve this goal? It has to be measurable. When have you reached success? It has to be attainable, considering all of the other stuff going on in your life. I mean, I would love to be independently wealthy, but unfortunately, that's just not attainable for me. How is this relevant to your life or other goals? And time. You notice we say time an awful lot. That is incredibly important. So here's an example of the SMART goal framework, and we're going to facetize it a little bit by adding 2 letters onto it when it comes to purchasing a home, because of course we're talking about home buying later in the presentation. So be specific. You want to buy your dream home. How much will it cost? In this example, $500,000, and you want to achieve it in 4 years. Has to be measurable. If you're going to put 20% down, you need to save up that $100,000 down payment. How are you going to achieve it? Well, $2,000 a month or 50 months. If you are chasing this goal, is it attainable? Will this impact your ability to save for retirement or achieve your other goals? Is it relevant to your life now? Well, if you just got married and plan on starting a family and you need a bigger home, then yes, it would be relevant. Once again, the time frame the person set was 4 years. And then we're adding 2 more things onto smarter goals. The E stands for evolve, because we know personal situations change. We may need to go back and reassess our goals. Maybe you were set on buying a home, but you got a job offer that's a couple states away. Then all of a sudden you decided, well, maybe I shouldn't buy right now because I'll be moving to a new state. So you have to reassess. And reward yourself. As you're working towards your goal, maybe put mini rewards for every small milestone that you achieve. Pouring your financial foundation. A lot of people want to jump in to do the fun, slick stuff when it comes to finance, but they don't have a firm foundation. And we know what happens when we build a home on a shaky foundation. It doesn't stand. So there's 4 key things we want to make sure we have. Understand our expenses and cash flow. We'll talk more about that in a bit. Have an emergency fund, 3 to 6 months, for some people, perhaps more than that. Get rid of that high interest credit card debt and make sure you are properly protected. Talking about insurance. You want to make sure that you have proper home and auto coverage. If you need life insurance, meaning if you were to pass away, would someone be impacted negatively in a financial way from that? You may need life insurance. Disability coverage. What happens if you can no longer work? For many of us, our ability to generate an income is one of our biggest assets. So we want to start with these key things to build a firm foundation. On to managing money. We're going to talk about that thing a lot of people don't like to talk about, a budget. And I will admit, there have been times in my life where I was like, ugh, a budget, that doesn't sound fun at all. But it's not as scary as people think. It's just a plan on how you're going to spend your income, use your resources. And it is a roadmap for your money. And oftentimes people don't like budgets because they fail. And the reason why is they're overly complex and it's not personalized to you. Keep it simple. What works for you? For some of you, you may like to use cash and envelopes. Maybe there is an app on your smartphone that you like. Perhaps you use something like knit.com where you need a budget. For me, I found that I like to make sure I put all of my money in savings that I need for my long-term goals, my short-term goals, anything, expenses that will be coming up. And then I know what's left over, I can spend in a flexible manner. So make sure you find a budget that works for you. The right outcome from a budget. First, we have to have a really good hold on our expenses. It's so important to know that. Oftentimes, people don't pay close attention. And when they go in and look, they may be surprised at where they're spending their money or how they're spending their money. It's important to spend your money in line with your values. We talked at the top about setting a goal. We want to make sure that our money is going towards that goal. I'll have folks tell me retiring by 60 is very important to me, but I see most of their money is going to Amazon. So when I'm looking at where the money's going, it looks like Amazon's the most important thing in your life. So we want to make sure we're spending in line with our goals. Paying the important things first, and of course, have a little fun. So how do we actually do this budgeting thing? First, we start at the top. We look at our biggest expenses. You'll hear a lot of people talk about spending money on lattes and coffee, and maybe that's something you may have to cut back on. But most people spend the bulk of their money on housing, cars, and food. So we may not say you have to cut out your latte, but maybe you have too much house or car. And after we look at the big things, then we filter down and look at those smaller things, the sand in your shoes problem. And a good guideline is the 50-20-30 framework. I'll explain how this works. 50% of your money should be spent on the essentials, the stuff you need, your mortgage and rent, your utilities, gas, groceries. And it makes it really easy if you get paid twice a month, because you can say, well, does my first paycheck go to all my essentials? And then the second paycheck, you want 30% of that to go to fun stuff, eating out, hobbies, charity. And then 20%, you want to use that to save for your long-term goals. Now, if you're not there yet, oftentimes if you're working to pay off debt, you may not be there. Maybe you have a bigger essentials bucket because of those debt payments. That's fine, but let's make a plan to get there. Take the 1% pledge. If you're not quite there yet, make a plan so that every 6 months or every 4 months or every year, whatever the interval is, you increase the amount that you're putting in that savings bucket by 1%. It might seem like a little bit, but that 1% plus 1% plus 1% adds up over time. And it makes it easier than doing a big chunk at once. Now, what happens if we have an emergency? Life happens. Your kid breaks their leg. The car breaks down. What if there's a job loss? We understand these things do occur. And that's why it's so important to have an emergency fund. So when you have a setback, pause, take a breath. This is why we've saved emergency funds. And once it's over, we can create a plan to rebuild them. Now, how much should you have in an emergency fund? Typically between 3 to 6 months. Perhaps if you think you have a job that it would take longer to replace if you lost your job, maybe you want to be on the longer end of that. It just depends on your circumstance, how many months you feel comfortable with. And if you get something like, instead of a bad thing happening, if you get an unexpected inflow of cash, make a plan for that too. The first thing you should do is go back and look at your goals as to how you're going to spend that money. Because oftentimes when we get cash you weren't expecting, it just somehow magically ends up being spent and we're not sure how. The same thing if you get a raise. Make a plan, go back to that list of priorities and goals and figure out, okay, if I got a 5% raise, I'm going to put 1% towards this goal and 2% towards that goal. Make sure you spend in line with your values. And don't forget to reward yourself by putting extra money into that fun bucket. Now, to wrap up this section, a few principles of cash flow. Your spending should be personal to you and your situation. Personal finance is personal. Make sure you have a good overall handle on your financial health. Planning out your cash flow is important. You need to know where you are spending your money. When we're looking at our budget, think about those big items: housing, cars, food. And when we look at our cash flow, we start at the top. We start with our net income, then subtract all of our expenses, and that's what we have left to work with. Purpose drives progress. Knowing those goals helps you drive where your dollars should go. And make the irregular more regular. So this is if you have an expense that isn't monthly, you have something that's quarterly, or for example, our HOA fees are once a year. Make sure you have a plan for that. It shouldn't be a surprise. You know it's coming every year. So set money aside every single month. So when that quarterly or annual bill pops up, you are ready for it. And of course, have fun. So that is it for our section on credit, on managing money. Credit and debt is next. And while we're switching, because Beth Lynn will handle this part, a quiz question for you to think about. What factors do you think are used to calculate your credit score? All right, Beth Lynn will take it from here.
I sure will. Can everybody hear me? Awesome. Awesome. That was wonderful. And now it's time to jump into a quick question. And if you want to answer that question by giving a response in the chat, we are ready to take your responses. I want to kind of see where everybody lands with that. I'm going to go into presentation mode right now. And then I might get out of presentation mode maybe at the end to show you a resource, but there we go. Did it go back to the beginning, guys? Oh, let me jump forward here.
We get a quick review of what we just saw this way.
Exactly. And hopefully you guys have good photographic memories. So here's the poll question as we dive into credit and debt. What factors do you think are used to calculate your credit score? Not quite the reading rainbow skill set here, but let's see what the chat comments and my colleagues, feel free to shout out. Let's see if there's anybody. Credit utilization, correct. Oh, I'm giving away the answer. How often I pay on time. Oh, there you go. Yep. You guys are quite knowledgeable here. I think it's time to show the, yes, I think it's time to show the results. Really great answers. And I think some of these you've already mentioned. So let's narrow them down here. Your income, how much you owe, how much you have in the bank, the number of credit cards in your name, the value of your investments. Can someone put in the chat which of these options is not part of calculating the score? Going once, going twice. Correct. Yeah. Laurel did, and zip code, obviously. But Laurel, thank you so much. So here are the answers. How much you owe, that speaks to how much credit you're utilizing. And we'll get into credit in a bit and unpack that for you. The number of cards in your name. And that also speaks to different types of debt. And then how many late payments you've made, that history of your credit, your payment performance also goes into that. Great, great, great. Now we're gonna stay high level in this lesson because we've only got an hour and a half, but I did want to put in a plug for our Facet resource on facetwealth.com/credit. you guys can spend an hour just on this topic. So don't hesitate to educate yourself, okay? As we give you more of a cursory overview today, but you can do a deeper dive on our website, as Shatila mentioned, in terms of our resources. And I keep going back to the beginning. That tells you how how much experience I have with PowerPoint. Okay, I'm telling on myself. So jumping ahead here with credit. There are a number of parties when it comes to credit, but before I go into that, I'm just going to go over the objectives of the section that I'll be facilitating. So here we are once again. What are we going to be covering today? And I promise I will not go out of presentation mode. We're going to be covering, okay, the credit system and how your score is calculated. And we'll then take you back to the basics and really cover debt. Speaking of the debt landscape and your debt to income ratio, any of those terms ring a bell. And then we're going to wrap it up with some things we want you to avoid. So mistakes, keep an eye out for those things. And also it's important that healthy habits, excuse me, I'm from the Caribbean, so I just say healthy and not healthy, if it sounds like I'm butchering these words. Really and truly, when it comes to credit, it does affect, pun intended, all the facets of your life. And for example, if you take a look at life insurance or insurance, you might think, how does life insurance affect my credit? For example, if you when they do pull your credit and they see bankruptcy, that does affect the pricing on your life insurance. And then on the left, it does affect your ability to really keep the earnings in your pocket. It can erode savings, and it can cause you to spend more, right, if you don't win at that game of credit. So it's this cyclical, every area of your life impact. And we want to get ahead of that. Now, specific to credit, which is a type of debt, but we do want to hone in on it, is your credit score equation. And here we have the different parties, per se, of the credit score. At the end of the day, you are the most important step in this process. The credit bureaus, which you see here on the right, and I'll get more into, they have their objectives and their goals. And FICO, which is an independent scoring entity that has its own algorithm to determine the prediction of how well you use credit, they have their goals and how they want to make money. So you need to focus on you, educating yourself, and making sure you win as it relates to this process. When it comes to the three credit bureaus, we've only recently, since 2003, had the opportunity to have our credit scores disclosed to us. But they're in the business of really gathering data. And the record of your payment history gets reported to these entities or bureaus at no cost to them. And then they sell that data. So they're in the data business. So if the data isn't right, they take offense to it, but stay the course and dispute this and get your disputing on, right? But they're in that data business, and they sell that data through, if you've got identity protection services, or if you're applying for a loan, the bank may reach out to any of these entities or bureaus to be able to determine if you are creditworthy to extend debt to. So they're in the data business. FICO has an algorithm that they sell to determine your score. So your credit report exists when the data is pulled. So again, the credit report is not a static report that's kind of sitting out there. when you request a report and determine your score, they're pulling all of this data together, and they're reporting your history, as you know, the different types of debt, your utilization, as we talked about, on demand as requested. So it only exists when it's time to be requested of either yourself or through any of these entities. And there are other different ways and organizations that might pull your credit. So it is very important to know what that report card is saying about you, because it determines, like you saw before, right? It impacts every facet of your life. Well, the next slide, and I'm going to go into, really sets up one of the more widely used scores that's out there. There is a more recent score called the FICO 10, and when you go to our Facet Wealth website and you dive into that credit webinar, that webinar focuses on how the FICO 10 score changed from the FICO 8 score, but we're really going to focus on FICO 8 because that is what most of the bankers and lenders and institutions out there leverage. That's the one that's more popular. And as you see here, if you just look at the kind of high level top-down dynamics, FICO 8 score has about 12 scorecards, about 8 are derogatory scorecards, and then 8 are non-derogatory, and then 4 are derogatory. So for example, if you might wonder why your score is always changing, because first of all, your score is calculated differently by the different bureaus, so that's changing. But what happens is that they look at your current credit, they look at your credit history, and then they look at the national default rates of folks that have a similar history to you. That's a great question. What's my opinion on Credit Karma? A great question. And they look at others who have histories to you, and they put you on this scorecard. And there's just so many points that you can get if you're on this scorecard. So for example, if you're on a scorecard that's like a bankruptcy scorecard, you might have to do something very differently to jump from a scorecard that has more of that negative derogatory reflection, by making sure you're working on the other things that affect your score, right? Utilization, paying on time, maybe jumping scorecards and getting on someone else's great credit history. They call that piggybacking. So there's really a complexity. They haven't disclosed the algorithm per se, but again, it starts out with what's your history now, and then it looks at what's your history, what is your current credit situation, what's your personal history, and then how does that compare to the national averages of people whose history is similar to yours, and then you're put on this scorecard, and then they determine, okay, how, with their algorithms, how likely is this person to be of great credit worthiness? So they're taking this history and they're predicting how you will perform in the future, and that's what determines your score, right? And so I guess I'm just trying to answer the question, why does my score change so much? What's going on? Or why isn't it moving? Because there's always these different scorecards and segmentations, and national averages and caps within the scorecards that affect you jumping off of one that doesn't give you any more budge in your credit score unless you do something different. And here are the areas that you can impact or affect or understand in terms of how that the FICO algorithm works. But your credit score is made up of these 5 parts. And ratios here, right? So if you think of these around 8, these each get a segment of that, right? So when it a big chunk of it. You have to take that seriously. One of the ways that you can make sure that happens is set up auto payments, and maybe at least always set it up to make your minimum payments so that you do not miss a beat. I like a $25 shoe at Macy's, but I hadn't done that in the past, and I called up and they said, "Can you waive this? I'm a good customer," and they waived it. So it was really nice to know that that there is that ability. And if you haven't done that, you should definitely take advantage of it. Amounts owed also makes up a big chunk. That's like 65%. And the key here is how much of your credit are you utilizing? And a lot of the score, your score is driven by mostly your credit cards, your unsecured debt in this area in terms of amounts owed. So for example, if you've got a credit card with a $50,000 limit, and you have $5,000 of spending on it, then you are at a 10% utilization, right? So how much do you owe? You owe about 10% of the limit. And general guidance is try to stay within 30%. I've seen a lot of credit experts, repair experts speak to 19%. So the lower, the better. And make sure that one of the hacks also to make sure that they're reporting that you are actually making your payments on time or paying off your credit cards against that amount owed is to wait until you are billed on your credit statement and then you pay. Because if you don't wait until you're billed, then they're not going to be able to report that you did such a great job, right, against what you owed to bring that down. I know that has been an eye-opener for a few people. Also, just want to highlight on here, because I know most of you know what makes up a credit score. You put it in the chat, right? Starting early with your credit history. If you can start with a secure card for those that are early in your career or working years and don't have that much experience with credit cards, and then you can shift from a secure card to an unsecured card, that would definitely help. And I know the piggybacking concept helps too with having that length of history to show that consistency in paying on time. But don't be overwhelmed with your score. If you have, if you have a score that you would like to improve, it probably didn't take you overnight to achieve that score, and it's not going to take you overnight to see it go up, right? But the key is to educate yourself with regarding the fact that they're trying to predict, right, in that score, your likelihood of credit worthiness. So making sure the lion's share of what makes up the score in terms of what you tackle is key. And let's go on to the next slide. I think, so here is a FAQ, a frequently asked questions that I tend to get. What is a good score? And you might think, although we are tranching these scores accordingly, and you see the definition here in terms of a good score, that a score that falls into the fair category will not be able to allow you to do certain things, but you can have a fair score and still be able to do certain things. I know for some folks, they're concerned with purchasing a home. It's just going to be a lot more lift in the process. So ideally, you don't want to be on the lower bookend of the fair score, just for example, because of how that process would work for you when looking to borrow. You definitely want to work on having that score that positions you favorably, and we'll go into how that even affects the borrowing costs, called interest rate. But depending on where you are in your professional life, don't despair as you age. And I know sometimes people have life events and they may get setbacks and they need to rebuild. Your credit score will be richer over time. So hopefully, depending on where you fall here, that could give you a sense of how am I comparing with my peers in this regard. And there are great benefits. As I said, I was going to kind of have you take a look at the different types of loans and how the cost to borrow does affect you. If we just take a look at someone that has excellent credit, whether it's here they're buying a house or they're purchasing a car, but specifically for their mortgage, right? The interest rate could be very favorable. And then over time, this is a great picture to show that the cost to purchase a home could pile up for someone that has a history and connects that score to predicting how they might handle borrowing in the future. So we definitely want to not be allowing the facet of our life as it relates to not paying more for things than we need to, by paying close attention to our credit score, because it does affect your pocket in the long run. So where should you be? We have the legend on this chart, which gives you the kind of good, excellent, and pretty good score ranges there, which is the green, the hunter green, and the blue respectively. So depending on where you are in your age group, we hope that you are somewhere in that area. So take a look at really how your peers stack up. So as you age more toward retirement years, you should see then that of your peers that you should have the history and wherewithal and backing behind you, right, to really get that credit score up. Right. But when we look at those that are in their 30s, between 30 and 39, most of their peers aren't in that higher score. But the goal is to get there soon and get the healthy habits going now. All right. And as we're using credit, there is it impacts our score positively and negatively. So I just kind of wanted to throw out there the impact of various actions on your credit score. Again, going back to that pie chart per se, where on-time payments and low credit utilization is where you want to be. And then if you do have the public records that are out there, although it does stay on your record, you can continue to do those great healthy habits to see that score rebound. And rebound, speaking of rebound, this gives you a chart of, and most people probably are aware when it comes to bankruptcy, how long does a certain activity stay on your score. In terms of obtaining new credit or closing an account, not too long. But when you have those missed payments and when you have those public records, it does stay on your account much, much longer. So if one of the things when you are looking to do credit repair is to make sure you have all the facts, because you definitely do want to dispute the data that the credit reporting industries or bureaus rather are reporting on your behalf. Which speaks to getting informed here, where to get your report. One free report a year is allowed via annual credit report that of these three bureaus. The strategy that I give my clients is maybe the first quarter, the first trimester of the 12-month period, pull one, and then the second, pull the next, and then the last, you pull the third one there, so that you can access them throughout the year and not miss the ability to grab them from all three by doing them all at the same time. So spread them out throughout the year. You do get one from each bureau, and that is a cool strategy I like to tell folks. The reports are very detailed, and you do want to take the time to look at them. I'm not going to really spend too much time with the things that you want to pay attention to, but even as your personal information you want to pay attention to, because a wrong letter could impact the wrong information in your name being pulled in. Okay, so that was credit, specifically to the credit score. And now credit is debt. And there are some basic terminology that I want to kind of just go over when you borrow. A debt credit is a mortgage, an auto loan, all those things, they're debt instruments, right? There is a lender and a borrower. If you lend your money out to me, that is your original, that's your principal, and you want me to pay you back at some point in time, that's the term. And because you're foregoing using that money to do what you need to do, you're going to borrow that. So that's the interest rate. Now, most of us are probably on the other side. We're not probably the lender, we're the borrower, but that's essentially the different parties that exist. You've got the lender and the borrower, and then the different elements of that product. Amortization is a word that would come up a lot for mortgages. It just speaks to killing your debt, like a mortuary amortization, just really killing that debt. But you're doing it over a period of time. And in that payment, most of that payment in the earlier years is going toward your the cost to borrow, which is interest. So if you can pay more on a mortgage payment above the payment, then that will make sure you are killing that principal and paying less interest over time. And we're going to be learning about the home purchase process in a bit, but fees, and Danielle is going to dive into that. But here are some additional terms that you should know. Application fee to administer the loan, there's a processing fee. Also, there may be late fees, and I told you I got mine waived, and you can probably get yours waived if you just call. And sometimes when you're in a loan contract, there may be a prepayment fee, so pay attention to that. If you really want to pay off your debt early, that is something you want to ask about. That's definitely a good FAQ to ask or inquire of, okay? Now, how much debt should you carry? You definitely want to keep a low debt to income ratio. And on the right, we've got some benchmarks for you. For housing related expenses, up to 28% of your gross, that's before taxes, should be spent on housing, your principal, your interest, your taxes, your insurance, maintenance, all in, right? And then all other debt, in addition to your housing, we hope that that's no more than 36%. So I know Daniel's going to talk about this some more, but just be careful to make sure you're not borrowing too much, you're not buying too much house that you can afford. Otherwise, you'll be living to pay a mortgage, right? And she'll talk more about that. And then how much debt we carry does depend on our life stage. So don't be too hard on yourself. As you age toward retirement, you should be knocking off those debts. And then, like I said, if you're rebuilding, that's fine too. I typically get this question: pay down debt or invest. What do you need to know? To determine an answer to that, you want to understand if you weren't going to pay down your debt, how much money could that cash earn, right, if you didn't pay down that debt? So if you have a whole lot of money in the bank, and banks aren't paying 2% right now, but not even 2% for high yield savings, you're only getting 2% on your money. But if you apply that cash, obviously leave some money for emergency fund, maybe $1,000 or so, depending on whether you're a 2-person household or 1-person household. And we can talk more about that in the Q&A. But if you take a look at the immediate return you get on your money, right? Because the cost to borrow is so much more. So when you apply more toward your debt, you are getting that immediate return, which is that interest rate. You are lessening the amount that's going out of your pocket in the long run. Because if you hold on to it and just keep it in the bank, except for emergency, you are not making that much. And here we do have a diversified portfolio that could be making that much, but compared sometimes to some of your other debt, it may not stack up. So your plan is personal. Know what motivates you, right? If you feel like there's low-hanging fruit there that you might want to pay down something because it makes you feel good and that's a value to you, know yourself, and that's fine too. This is good. I really want to jump to this slide, so that's why I'm like stalling a little bit, but let me just stay here a bit. And it really speaks to what I was mentioning here. So leading into you're paying down debt, there is a method to the madness. You can focus on the highest interest first, and some folks like to pick the low-hanging fruit and focus on the smaller balance. So it's your style, it's personal to you. In the long run, you're going to get there. To stay disciplined and stick to the plan. But here's a client of ours at Facet who had a lot of debt. And this to me is analogous to not putting your head in the sand. Better late than never. Really listing out all your debt and having a plan to be able to pay as less interest as possible. And this person, if they had just paid the minimum payments, they wouldn't be able to get out of as debt as soon as we're modeling here, which is the latest, October 2024. So crushing your debt by paying more than the minimum and then just snowballing it. In this case, it's the Avalanche method where we're doing the highest interest first, will save you money in your pocket. And as you see, they were able to save $8,800. Some takeaways when you're navigating the debt landscape is make a list of your debt. Don't put your head in the sand. Understand who the parties are for the debt that you hold. List the specs, the specifications on it, and understand the monthly payment. Understand how you can kill that debt by paying more on the principal. Definitely don't forget your due date. That helps your credit score. And then make sure your cash flow, it makes sense for your cash flow, right? How much are you paying each month? Is part of the whole getting organized process. And we do want to make you aware of some mistakes to avoid, right? Believing qualification is a form of approval for what you can afford. This is a big one, right? You can get approved because of your income by lenders for a $500,000 house, but we want to make sure you're not buying more house, right? So make sure you can afford the house and you're able to navigate other goals, okay? And make sure that the goal reflects the value, right? And then make sure you're organized, because if you're not organized, then you're going to miss something, and we cannot afford that. And this is really just a repeat of what we already know. Do not miss any due date. And as Shatila said in the beginning, it starts with a plan. If you tell me you want to pay off your debt, and then we look at your historic spending and everything's going towards Starbucks, right? We need to reevaluate things. So make sure you have a plan, and then make sure you tell your budget what to do. And that was it, because I'm a talker. I can talk. Hopefully you guys were able to get a lot out of that. And now I'm going to turn it over to Danielle to go into the other topic, buying a home.
Good evening, everybody. As I'm sharing my screen, I know that we talked through a lot so far. So if anyone needs a moment or a break, is it all right if we take like a quick 2 minutes if anyone wants to get up and stretch, and then we can circle back at 7:25, or should I just sort of power through?
We can take a 2-minute break. That's fine.
Okay, so if we just want to pick back up at 7:25, and then we can dive right into home buying and that process.
Sounds good.
All right, good evening. I hope everybody is logged back on and ready to go. So again, my name is Danielle Alcid, and I wanted to share with you guys and talk through the process of purchasing a home. So as Bethlyn had explained and talked through a little bit previously, when we're looking at buying a home, one of the top things is making sure that you're in good credit standing in order to make that purchase. And so one of the questions that often comes up is renting throwing your money away? And I did see in the chat or saw a question where someone is considering, should I buy a home or not? Because I don't necessarily foresee myself staying where I'm currently working and living, right? If you don't see yourself staying there long term. So the answer to that question really is, it depends, right? And for various reasons, right? Some of it could be what's going on with family. Some of it could be, I don't intend to either stay in this role or with this firm long term. Or, now that we're working in a virtual environment, the opportunity to not have to be tied to a specific locale to do your job is enticing for a lot of folks. So they may not necessarily want to purchase where they are currently living and working. And so in that sense, right, it makes more sense to rent than to buy. Planning to buy a home, though, is a fairly large decision that I will say that's why it is important to work with a financial planner, because they're able to help ask some of the questions that you may not consider or had not thought of as you're going through that decision-making process. And so part of that is, right, defining your goals. Why is it that you're looking to buy a home? And what is it that you want in that next, that place you call home, whether that's a house or whether you're continuing to rent an apartment. And typically, when we're looking at like the top things that consume our income, a home is at the top of that list, just because you're considering not just the purchase price of that home, but whether or not there are additional fees such as your HOA fees, property taxes, insurance, maintenance, things like that. Also, knowing what makes sense for your financial situation. Sometimes it's better to continue renting while you're saving for a down payment, because you want to make sure that your monthly payment on the mortgage is manageable, right? You want to make sure that you're able to get the best rate possible when selecting the type of mortgage that you're looking for. And then also ongoing maintenance, right? So if you're someone who doesn't enjoy gardening or being, outdoors like that, then maybe a home that is low maintenance, like a condo or a townhome, makes better sense than potentially a single family home or a duplex that could require more maintenance. And then also, what does that next chapter of life look like, right? Are you looking to get married? Are you currently married? And you guys just want a bigger home or a newer home, or maybe you're downsizing? Are you starting a family, saving for college, things like that? And we do encourage, whenever you're going through that home buying process or thinking through that home buying decision, is looking at what does the next chapter of your life look like a year out, 3 years out, 5 years out, and so on, because it is a large investment, right? That is a pretty big commitment. Secondly, when you're planning to buy a home, we want to look at cash flow. And as Bethlyn mentioned previously, right, the general rule is you want to be spending about 28% pre-tax on home-related expenses. So we don't want to be spending too much more than that, because we can potentially end up in a situation where we are house rich and cash poor. And with that, right, the parts of the cash flow are considering your income, understanding what resources you'll have to pay your mortgage, and that ongoing maintenance and those other expenses. Looking at other debts that you have, right? Is it feasible in the time frame that you're looking at it to manage both the debt of a mortgage payment as well as any other debt, whether it's auto loans, student loans, consumer debt, things like that? What cash would be available, right? Are you going to empty out all of your emergency savings in order to purchase that home, or will there be some left over for true emergencies? And then also lifestyle expenses, right? So, I mean, it just depends again on what you value. So if purchasing a home then sort of locks you into not being able to travel the way that you enjoy traveling, those are some of the things that you want to consider in terms of trade-offs, as well as saving for other goals, right? How is that competing with a potential a potential vehicle purchase, maybe saving for, kids' education, retirement, things like that. And then what sort of lifestyle changes could be, coming down the pike, right? Are you guys already, are you expecting to expand your family? Are you expecting to become empty nesters, right? So there's a lot that can come into play with that decision making. A lot of times in meetings with clients, I'm interestingly working with several clients who are in the process of purchasing a home this year. And the question that immediately comes up is, do I need to put down 20%? Again, you don't have to, but you do want to consider that if you put down less than 20% of the purchase price on a home, then there's something called PMI, which is mortgage interest or mortgage insurance, basically. And what that is it is insurance that is tied to the mortgage, so that until you get to 20% value or 20% equity in the home, that's included as part of your mortgage payment. So when breaking down the down payment, right, what's so special about the 20%? Lenders, it's really for the lender, right? Like in risky and uncertain markets, they want to make sure that they have some protection in case you foreclose on the house, you don't pay your mortgage. They want to make sure that they have some protection if they have to take ownership. And so, yeah, to this third point, right? No bank wants to take your home, but they have to protect their investment, right? They're lending it to you and they want to make sure that you're able to make those payments. So a lot of times that's where that 20% comes from. The what and why of mortgage insurance premiums. So basically, it's protection for whoever owns the loan, whether that's through federal programs like Fannie Mae and Freddie Mac, whether that's the lender itself, the bank, or if it's part of an investment where there's different investors who own a portion of your loan. And basically how it works is there's an upfront premium that is paid at the time that you purchase your house, and then it's an ongoing monthly cost that's included in your mortgage payment to cover those insurance costs. And as I've mentioned before, particularly if there was an FHA loan, it no longer just falls off. You would have to refinance your mortgage. And so typically what happens is once you've reached, again, that 20% in home equity, so the value of your house has grown more than, to at least more than 20% of what you still owe, then you can refinance your mortgage to maintain the same loan amount and potentially lower your loan payment, because you'll be able to get rid of that mortgage insurance premium. In terms of the term, right? So when thinking about purchasing a home, as we talked about, right, lifestyle changes, what do you think your life looks like a year out, 3 years out, 5 years out, can determine the term that you want on the loan in terms of how long you want to be paying for that mortgage. Should you do 15 years? Should you do 30 years? And again, the value of working with a financial planner, because the answer to every single one of these questions is it depends, because it's so personal and based on each individual's experiences and what their upcoming expectations are. So the types of mortgage, you can have a fixed rate, which is a 15-year mortgage, a 30-year mortgage. And on that fixed rate, that means that that rate is set at the time that you start the mortgage, and it will not change for the entire term, whether that's 15 years or 30 years. And do also an adjustable rate mortgage. An adjustable rate mortgage does adjust or can adjust at predetermined intervals, but there is also a cap on how much it can go up. So for some, rates, right, for some terms, if it's a 5-year adjustable rate mortgage, it can go up within that 5 years at the predetermined intervals. And so that's something that you want to look at just in case you're in a situation where an adjustable rate mortgage would start you out with a lower payment. So things to consider. That's why it's also really important to not just have a good financial planner, but also a really good realtor and a really good relationship with your mortgage lender, because they'll be able to kind of more fully explain these terms to you and make sure that we're not putting you in position to make a poor decision and end up paying more in the long run. And then there's also interest only, right? And so that means that, as Bethlehem had mentioned before, when you're talking about an auto loan or mortgage or something like that, the interest rate is predetermined at the very beginning of the loan. And most of the time, your early payments cover mostly interest and not as much principal. An interest-only loan does allow you to pay just the interest for a set period of time. And then at the end of that time, as Bethlyn had talked about in terms of that term amortization, you're now then, the loan, then you have to start paying back principal and interest. So the payment will end up going up. When you're looking at your mortgage and you're going through these terms of PITI, basically what that is principal, interest, taxes, and insurance. So that is your total monthly payment. And that is usually because the taxes and insurance are put in escrow, and then the mortgage company will pay those on your behalf. It's not something that you have to think about and manage, whether taxes are due annually, semi-annually, and so forth. And then special circumstance loans. So special circumstance loans are Federal Housing Authority, so FHA loans, or Veterans Affairs VA loans. And what this does is it allows you to typically put down less than the required 20%. And for FHA loan, I did see that, like, so typically you can put down anywhere from 3.5% to 10%. And sometimes for VA loans, you can put down less than that, sometimes with no down payment at all. So the most important aspects of the home buying process, you want to make sure, again, this is a very personal decision, and it is a very personal process, and therefore needs very personal planning. So you want to think through what your current and future needs are, what you value the most, and then put a plan in place to start down that process, right? Another thing is location, right? Location. That's what realtors will say every time. But for you, location matters, right? Do you foresee yourself being here for a very long time? Do you see yourself being able to raise kids, things like that? Just on a personal note, with my family, we were relocating from Philadelphia down to the Charlotte area, North Carolina, 4 years ago. Yes, it would have been nice to live like right in downtown Charlotte because we've never lived there before. But then we also have to consider, what would that look like for a commute to school for 3 boys, right? What does the school district look like? Is this somewhere that we can be for a long period of time? The things that were important to us, right, include outdoor space. So those are the things that you want to consider when you're thinking through the location of where you want to live, and a host of other factors. But you want to list out what your primary goals and values are. And again, as I mentioned, your lenders matters as well, right? You want to make sure that you're dealing with someone who is looking out for your best interest more than they're looking out for their ability to close a loan, because they might try to convince you that you can afford more than you actually can just because you've been approved for more. It could be a situation where you don't get the best interest rate because they have certain relationships. So you want to vet your lenders as well as your realtors to make sure that you're getting the best situation for yourself. And then lastly, know your timeline, right? So if you know that you're looking to purchase a home in 3 years, you don't want to wait until you're at the third year to start planning for that. You want to start thinking through some of these questions as you're building out a plan so that you can save appropriately, start your search, things like that, so that it can be a less stressful process. So the home buying process, kind of soup to nuts. First thing, right, is finding a real estate agent. They're going to do a needs analysis with you, right, to understand what are your must-haves, what are your deal breakers in purchasing a home, what are the absolutes that you need to have in order to be comfortable moving forward. And then you'll go through pre-approval, where you're dealing with making sure that your credit history is in good shape, that your debt to income ratio is in good shape, all of the things that Bethlyn had shared in the previous credit and debt conversation. And then selecting a mortgage, right? What's the right type? Do you want it fixed? Do you want the adjustable interest rate only? Things like that. And then your home search, right? So looking for that dream home. Sometimes you find it on the first shot. Sometimes it takes 10, right? It just really depends on, again, what the location is and what are the deal breakers. Then you want to make an offer. Sometimes the offer can be rejected out of hand. I know right now we're dealing with a super tight home buying market. So a lot of times there is no negotiating. It's, what's your your best and last offer. And then once that is accepted by the seller, you enter into contract. And once you've entered into contract, you've got 30 to 45 days for the contingency and due diligence period, where you do the home inspections, you get the deeds researched, all of that fun stuff. And then you go to settlement, where you get the keys to your new home. It can feel like a very long process, but sometimes it can move pretty quickly. And so it really is based on the timeline and what's most important to you and how quickly you want to be in a new home. So I'm going to pause there because I know that we have, I know we're doing some Q&A at the end, but if you have any questions, feel free to put those in the chat as we are coming to the last portion of our presentation, which is investments. And so for this part, I did want to speak to this because how you balance your investments and what that looks like in terms of how it helps you meet your goals is really important when we talk about how do we manage our money. What does it look like when we're trying to decide, should we invest versus pay down debt and all those various things. So from a very high level, right, Facet, we believe in 5 core principles when it comes to how you create an investment portfolio. And as we've mentioned kind of throughout our conversation today, it starts with a plan. It is highly personalized because it is based on your life and the things that are most important to you. So having a financial plan is the foundation of any sort of investment strategy. Second thing is we believe that the markets work, right? So the markets are efficient. And what we want to do is participate in the market, not necessarily try to beat the market, which basically means having the right allocation and making sure that you're broadly diversified, right? So having assets invested in domestic and international investments will overall, over the long term, benefit you when it comes to returns in the portfolio. Portfolio design matters, right? So we want to take appropriate risk in designing a portfolio that makes sense for you. And then looking at it with a long-term view, right? So time in the market, not timing the market, tends to lead to better long-term performance. And then lastly, having a disciplined approach is what will drive success, right? So if you're able to commit to that investment strategy and rebalance consistently, make sure you're investing appropriately and doing that in a disciplined and repeatable process, then that will lend to that longer success over time. And then in terms of just some helpful resources, I will go ahead and turn that back over to Shatila.
All right, let me just get in presentation mode here. All right, we're good with the screen? Okay, well, thank you, Bethlyn and Danielle. And we wanted to leave you with a few resources before we did the Q&A. So the first one, this place, they do financial counseling. So they can help with things like budgeting. And they do offer free financial counseling. So if you have questions on that, they can help you out. If you have debt issues, this particular nonprofit does credit counseling. They also do have some free credit counseling services as well. And if you're thinking about buying a home, this program called NACA, it is a program, their goal is to help low to moderate income folk own homes. So they have a fantastic program where they will give you down payment assistance. They will even pay for closing costs, but you do have to complete their entire program. And if you are a first-time home buyer and you're considering something like NACA, make sure you look in your local area for programs. I live in Arlington, Virginia, where many of you live in that area. And when I purchased my first home, Arlington County had specific programs for first-time home buyers. They even brought my interest rate down by an entire point. So there are programs out there to help you navigate this. Once again, how you can connect with Facet. We're on all the major socials. I talked about our webinar library. And if you'd like to schedule a consultation with us, there's the link down there, facetwealth.com/NCBW, the National Coalition of Black Women. I will drop that in the chat box as well. I think I'm going to go over this slide because I know we're getting short on time and we want to make sure that we're able to answer some of your questions. So before we answer questions, I want to pass it back over to Yvette. She has a poll, and once the poll is done, we will go ahead and start answering some of your questions.
Okay, great. Thank you so much. That has been a great presentation thus far. Bathsheba, you going to go ahead and do the poll? If you please, people who are attending, can you do the poll? It takes all of maybe a minute or two. It's really quick. It's yes, no questions, except for the first two. I think they're a little bit, but it doesn't take much, doesn't take long. So we'll give you about 2 minutes to complete that. Thank you. We'll give you a few more seconds. You're getting a lot of accolades in the chat, ladies and gentlemen, from Facet Wealth. Okay, you can end the poll now, Bathsheba. Thank you. Okay, Shatila, I'll turn it back over to you.
All right, so if you have any questions, please feel free to add them to the chat. But I'll start off with a couple of questions that we got before the presentation. And we haven't heard from Tarif, so I'll throw this to you first, Tarif. I'm a renter and I pay a lot in taxes. I was told I need to buy a house to help lower what I pay. I don't see myself settling here in this area. What can I do to help lower what I pay in taxes outside of buying a home?
Hey, thanks for putting me on the spot. I appreciate that.
We can help you out if you need some assistance, but I think you got it.
No, so a couple things. One, I know at different places, right? So part of this probably enough information so you're walking away with something. But now's your chance to really get your questions answered that's specific to you. So use this time as much as possible. But as far as that question specifically, there are benefits to owning a home versus renting when it comes to minimizing your taxes. So typically for all of us, we can qualify for the standard deduction as an individual. It's about $12,400. So no matter what, you'll get $12,000 as a standard deduction on your taxes. If you're a couple, then it's $24,800, I believe. Well, when you own a home, there's certain expenses that you're paying that is deductible. One of those expenses is property taxes. So that's going to be deductible up until the other is going to be mortgage interest, right? That's deductible up to a certain amount. Those are two things that you're not paying when renting, right? So those are a couple things that if you are owning a home that you can go beyond the $12,400 standard deduction and help to reduce your taxes. You want to be buying a home just because of that deduction, right? So you want to make sure that makes sense, but there are some benefits to doing doing so. There's separate benefits as well when it comes to an investment property, a little bit more complexity, but there's also deductions there that are beneficial. So hopefully that answered the question.
Just to tag in there, around like what to do if you don't want to purchase simply for the benefit of lowering taxes. One of the things that you can look at is if you have the capacity to maybe contribute more to your employer retirement plan. So by contributing to that, that is reducing what your taxable income is in terms of what you pay taxes on in your regular paycheck. But also when you file your taxes, that is something that is considered there as well. So taking advantage of, maxing out your retirement contributions, which I believe is $19,500 for this year. You can add $6,000 if you're over age 50 in terms of catch-up contributions. And then you also have the opportunity, if your income will allow, or your adjusted gross income will allow, is making deductible contributions to an IRA account. So that will also help lower your taxable income. But again, there are phase outs from the IRS based on your adjusted gross income. So hopefully coupling those together, we've answered the question about how we can lower taxes by purchasing a home or even without purchasing a home.
I agree. Just to jump in, focus on what you can control. What are those activities that you have access to or aren't optimizing? And at least that's the first step in the right direction to seeing immediate kind of return on the less tax liability stand front.
Thank you. Another one of those accounts you can contribute to is a health savings account if you have that sort of plan at work to lower your taxable income. Feel free to add any more questions in the chat that folks may have. Another question that we got, and I'll do this to Danielle since you talked about home buying. What credit score do you need to purchase a house? If your credit is less than desirable, what recommendations do you have to help improve your credit? And you probably got some of these answers during the presentation, but we'll address it separately here.
Sure. So typically for an FHA loan, the minimum credit score is about 580. They will work with you if you have a credit score lower than that. Typically what will happen is the mortgage lender is going to be the person that you're going to be in a lot of contact with. They'll tell you, like, if possible, pay off, and they'll sit with you, go through your credit report and say, if these debts are accurate, what are the ones that we can pay off quickly? Because to Bethan's point, when she was talking about credit and debt, particularly around your credit score, reducing that credit utilization is going to be really helpful to getting your score going back up, and that can change within the shortest period of time, right? So that's those are the low-hanging fruit that have a high impact in a short period of time, which is reducing that credit utilization and making sure that your payments are on time. Typically, if you're going with like a conventional loan, they want your credit score higher in like the mid 600s. But once you're over 615, 620, then it's really a question of interest rate at that point, and then how much you would need to put down. Keeping in mind, going with an FHA loan, you're typically putting down 3.5% to 10%. Going with conventional, they're wanting you to put down closer to 20%. If not, we're looking at that the mortgage insurance. So that answers.
And there's always, in today's environment, interest rates are very low. So one, it's a great time if you are going to be buying. Interest rates are kind of at historical lows, so it's a great time to do so. The downside is that there's very short supply. So homes are going for above what they normally do, and they're going pretty quickly. So a lot of times you got to bid above the asking price. I would say, as you're thinking about being in the market to buy a home, Danielle alluded to it, that credit utilization helps to, if you focus on kind of knocking down some of the credit card debt that you have, that can quickly improve your credit score. But if you're a person who has multiple cards, maybe multiple balances, it may be a good time to see if there's an opportunity to consolidate those, given how low interest rates are, and there's typically a promotional period as well. So if you have some time before you're actually going to be buying in the next 6 months, a year, maybe 2 years, right? If you focus on the debt and and optimizing that pay down strategy that Bethlehem may have talked about, then you can position yourself to get the best interest rate, because you can qualify for a loan at 580 for FHA, but the interest rate is going to be much higher if you're at a 650 or 700 or 750, right? Typically, you'll be in a position to not only get approved, but be able to negotiate with other lenders once you get above that 740 mark, right? So if you're above 740 in your credit score, you're a prime lender, right? Everyone wants your business, so they're going to start competing for your business, right? So if you have time and you want to focus on improving that credit score as much as possible.
So this question, whoever wants to take it, if you pay off your credit card, should you close it?
I'll take it. Take it. It depends, right? As Danielle said, it depends. But yeah, when you close your credit card, the nice thing is, because if you remember that pie chart, your credit history is about 30%. You don't lose your credit history. So that's great. What you need to be careful of, though, is your utilization. So it depends. You sort of want to look at your credit landscape and see where you are with those big pieces in the pie there. So for example, if you've got 2 or 3 cards and that one card that you paid off in aggregate of all the others allows you to have a higher utilization compared to what you owed, if you close it, you're going to take that out of the scenario, and utilization is a big part, right? How much you use it is a big part of your score. So you might want to like pay something off, freeze it, put it in water, put it in the freezer, do whatever you need to do to not use it. But you want to take a look at how closing it would impact your utilization, but your history will actually not be impacted.
Yeah, one thing that I'll add to that is when they're looking at your credit profile, they're looking at the number of different cards that you have, right? The mix of credit that you have. They're looking at your credit history. So you don't lose the history, but what happens is once you close out that card, it's no longer reporting on an ongoing basis, so it can shorten your history. So if you think about my son as an example, he's a student, right? His credit history is very short because he doesn't live long enough. He's only 21 years old, right? So the longer your credit history, the better that they have, the better gauge that they have and how well you can manage that, right? So if you shut off your card, that's no longer reporting, so that can shorten your credit history. Right. So typically you want to have that card still reporting positively, even if it's not being used.
And just to circle back on that, so to Tarif's point, no immediate short term unless it's utilization, but to his point, that long-term impact because it's going to eventually drop off. Great.
I've intentionally have kept the card I got in college open, even though it doesn't provide me a lot of benefits, just because it's my longest credit line. So I keep that card around just for that reason. But if you're tempted to go charge the card back up again, maybe you might want to get rid of it. So, all right, there's only one other question that we had gotten in the chat. So if there's anything else, we're almost to the time, but the last question we had was, what's your opinion about Credit Karma? I'm not very familiar with Credit Karma. I don't know if any of you guys are.
I can take it, and then if Tarif wants to jump in. I like Credit Karma because it's for educational purposes. It really helps to inform you on the activities that you do and how those activities could reflect movement in your score, especially around the pie chart. And Credit Karma is actually evolving and have all these additional products that they provide. I know for one of my clients, this is just an example. She moved from New York City to Philly, and she had an old Con Ed phone bill that she forgot to pay because she moved, and the Credit Karma alerted her that they reported that she didn't pay that bill. And I mean, obviously, if you paid for a credit monitoring, you'd be notified, but it's a free service. So it really helps if activity wise for you. So from an educational standpoint, I see that it's quite helpful. It does use a different kind of score calculation, though. It's the Vantage score. And the Vantage score came about when the 3 credit bureaus came together to come up with a competing algorithm score to compete with the FICO. And most lenders are going to use your FICO score, but the educational aspect of it, and then it's based just knowing from a knowledge standpoint that it's the Vantage score is just important to understand compared to the FICO.
Yeah, like Bethlyn said, it's a great place to get a gauge of what your score is, right? To know officially how lenders are going to be looking at your score. That's where you want to go to annualcreditreport.com, obtain your free credit report. If you want to view the actual score, a lot of times they'll make you pay for that, maybe a couple bucks, $5-10 for that. But you will get your actual score for the 3 bureaus, TransUnion, Equifax, and Experian. And that'll help validate what you're seeing on Credit Karma. But I wouldn't use it as Bible, especially if you're in the market for shopping for something specific. The other thing I would mention is when it comes to that credit utilization, right? If you think of your $10,000 credit card limit that you have to spend on it, ideally you want to keep that credit limit, credit usage below 30%, right? So if you got a credit limit of 10,000 and the balance on your cards is greater than that, you're at a 30% credit usage. Once you start getting above that, that starts to damage your score, right? So if you're kind of on that teetering on that borderline, as you're looking to obtain a loan, you want to make sure you're looking at your credit usage, keep that below 30, ideally less than 10. That's going to start improving your score and put you in a better position.
Now, Yvette, I know we're at the top of the hour. Do we have time for another couple of questions or do we have to wrap up? I want to be mindful of time.
Oh, thank you very much. No, you can go ahead with the question.
Okay, so there's a couple of other questions. I'm interested in purchasing a vacation home. What should I be concentrating on? My plan is to live in a warmer climate during the colder months. It sounds like a great plan.
Actually, this sounds like my wife. She in the audience. Yeah, you want to take it?
Yeah, I'll start and then you guys can chime in and add your piece. So when thinking about purchasing a vacation home, right? Some of the initial things that we talked about before around like affordability versus approval, right? So you want to make sure that you know, your overall like what you can afford to pay for it and what you're comfortable paying for it is kind of lined out, but also thinking through what your actual plan is. So if the idea is that you want to eventually spend the colder months of the year in a warmer climate, then we have to think through what is it that you want to do with it the rest of that year, right? Do you want to make it a vacation rental, or do you want to specifically hold it as your private second residence, mainly for vacation purposes? So what you should be concentrating on, I would say, is trying to determine what it is that what your plan for it is for that property, as well as your timeline, right? When do you want to begin utilizing it for snowbirding, right? Is it something that you want to be utilizing 3 years from now, 5 years from now, things like that? And if you have experience, with timeshares, I know a lot of times people will use that as an opportunity. It doesn't make sense for everyone. So I would encourage you, if not with Facet, to work with a financial planner, because it is a very personal plan. And there's a lot of things that will go into it, particularly around like, what is your cash flow? Do you have the capacity to add that on? Considering additional maintenance, additional property taxes, things of that nature. And then ultimately, what do you want the property to do for you? Whether you want to use that to generate secondary income, or whether you do want to use it primarily just for your own personal use during the colder times of the year. Bethlyn, Tarif, if you guys have anything, Shatila, anything you want to add?
I think that was great.
There's a question about, does Experian Boost affect your credit? I've seen some commercials about that. but I'm not particularly versed in it. Do any of you have experience using Experian Boost?
Yeah, so the Experian Boost, it does impact your credit, right? Because now you're reporting your regular bills that you have. So as long as you're paying on time, it's going to have a positive impact. If you're late on those payments, then it's going to have a negative impact, right? And typically those late payments have a larger impact to your score. And when you're looking at late payments, it's usually, it's considered a late payment is if it's more than 30 days past due. That's when it's going to be reported as late. So if you're using Experian, you're making payments on time, it's going to have an effect. It's going to have a positive effect as long as you're being paid on time, but it's going to be smaller. So they're not looking at that as heavily as they are other factors to your score. Also, it's an Experian product. So depending on the lender that you're going to, they may not be looking at Experian to get your credit score. They may be looking at TransUnion. They may be looking at Equifax, right? So it is a product that can help boost your score, but it may only be impacting your Experian score, not the other bureau scores.
So we got a question about timeshares, pros and cons. Now, we're not experts in timeshares, but I do want to give you a few guidelines. Make sure you fully read everything about this timeshare. One of my aunts got one and they thought that they could vacation in a certain place. And it turns out that there's not very many weeks there. It costs too many credits. So make sure you 100% understand this contract, what you are getting into. Once you finish paying it off, that is not the end of your costs. There are oftentimes the maintenance fees associated with the timeshare as well. This is not a quick one-time purchase. This is an ongoing cost. So we really want to make sure that you have the cash flow to sustain this over a long period of time. And I'm sure you may have heard, oftentimes there are some negative stories about timeshares. And if you no longer want it, it can be a challenge to get out of it. So those are a few general guidelines. I'm not an expert in timeshares, though. I think that's all of the questions that we got. I'll give it maybe another moment or two if someone would like to, if you don't want to send it to the whole group, you could directly message it if you would like. And of course, if you do want to schedule a consultation with us, I put the link in the chat. We'd love to talk to each of you about your specific situation. While having a general educational session is good, our answer about your specific situation and your cash flow will be better and much more useful to you and your family. So if you have further questions or you think you need help, reach out to us. We'd love to chat. All right, I don't see any more questions. So I think that's it. Yvette?
Yeah, thank you very much. I'm giving you all a hand. Y'all did an excellent job tonight. I really do appreciate this workshop. I'm sure everyone who was on got something out of it to their particular financial situation. So again, I want to thank you all. I want to thank everyone who attended tonight. And if there's no more question, I'd like to say good evening and have a great rest of your week.
Thank you for having us.
You're welcome. Thank you.